This Trader Planet video overview. During this brief presentation, we're going to take a look at a simple strategy using binary options to create a straddle in the currency market. Before we begin, please note future swaps and options trading involve risk. This risk may result in financial loss and is not suitable for everyone. The information presented herein is for educational purposes only. It's not a solicitation or an offer to buy or sell any particular financial instrument listed on Nadex. What we're going to be looking for in a straddle is a direction neutral trade with volatility expected. So we're looking for movement in the underlying. We're looking for pretty sizable movement in the underlying, perhaps around a fundamental news announcement such as a non-farm payroll report or a Fed decision. One of the key parts of this strategy is to know our full risk up front, and we'll have that with the binary options. We're going to strive for a lower risk, higher potential return trade setup. Like all trading, we don't want to get greedy, and we can set limits, and we want to make sure those are reasonable based on our strategies. Always trade according to your plan and your risk parameters. Here we have the underlying chart of the Euro USD spot market. Currently trading, when this was taken, at 128.50. We're going to be talking about options, so we are going to have an expiration date and time. Now this expiration date time, referenced by the blue line on the chart, could be 2 hours, it could be a day, it could be a week. There are multiple expiration times. So we're going to select a few different strikes. Again, it may be dependent on the market or what your strategy suggests on how far the market can move. But effectively, if we look at the upper 129.20 strike, what we're saying on the binary option is basically a true or false. Will the Euro USD be greater than 129.20, which is 70 pips away from the market, at our expiration date and time? Now this particular binary is trading at a bid of 9, offer of 13. What that's telling us is based on probability that there's about an 11% chance, the market's saying, that this may become true. Again, though, we're looking for volatility. On the other side, we're looking at the strike that's about 70 pips below the current market price. We see a very high probability on that trade at 87.91 bid offer. So the market's basically telling us the midpoint there, about an 89% chance. By selling at 87, we're effectively saying, will the Euro USD be greater than 127.80? We think that's false, so we're selling. Our worst case scenario on each side of this is 13 points. The binary that we buy at 13, worst case scenario, settles at 0. The binary that we sell at 87, worst case scenario is 100. So let's take a look. Here we got some volatility as expected. The market expired at B, and so the binary option that we sold at 87 settled at 100. Actually, all of our strikes settled at 100. So we had a loss of 13 points on the lower leg, but a gain of 87 on the upper leg. We only needed one side to prove out to either be true or false, depending on our direction, in order to make a very low risk, high return trade. In this case, it was a net of $74, not inclusive of exchange fees. This has been a brief overview of a binary option straddle. For more information, you can go to nadex.com and check out the education section. Thank you.